Welcome back to the Daily Crypto Roundup Deep Dive. Before we dive in, make sure you hit follow and leave us a 5-star rating if you're enjoying the show. It really helps more people find the podcast and keeps us growing every single day. It's been a brutal 24 hours for the crypto market. Bitcoin has slumped back to around $111,000. Across the board, we've seen about 5 to 6% shaved off the total market cap in less than a day. But the big question isn't just what happened, it's why. Because this wasn't a normal correction. This was a shockwave. And it started not on a blockchain, but in Washington. When news broke that President Trump's team had finalized a sweeping new tariff package targeting imported technology, semiconductors, and even electric vehicle components, the reaction across markets was instant. Equities turned red, futures plunged, and within minutes, the algorithmic traders that sit on the front lines of global risk began selling anything correlated to growth. And that included crypto. For better or worse, digital assets have now become a core part of the global risk complex. When traders de-risk, crypto bleeds first. The first wave of selling triggered a second. As perps dropped below key support levels, leveraged longs began to unwind. Liquidations accelerated. Bitcoin's funding flipped from strongly positive to flat within an hour. Ethereum's basis, the difference between futures and spot, inverted. You could actually watch the cascade in real time. $100 million liquidation on Binance, $200 million on Bybit, $150 million on OKX, all in the space of 15 minutes. The forced selling created its own momentum. By the time spot traders realized what was happening, the market was already $10 billion lighter. Analysts rushed to interpret the move. Some called it a purge, a cleansing of over-leveraged positions that had built up quietly during the recent rally. Others saw it as a simple chain reaction to macro fear. Marcus Sotiriou, partner at Impact Fundry, told The Telegraph, "A lot of people will have been hurt by this crash. A lot of people were over-leveraged." He added that the velocity of the fall wasn't purely organic. There were likely bots and large wallets pushing it along once the first triggers fired. Forbes framed it slightly differently. They said what we're seeing is a necessary reset, not the end of the bull cycle, but a recalibration after months of speculative positioning. In their words, every cycle ends up with too much leverage. The cleanouts are the price of progress. But behind all the numbers sits something bigger. Fear of what these tariffs might actually mean. The Trump administration's new trade measures go beyond the usual rhetoric. They're structured to directly target high-end technology imports, things like chips, data center hardware, and mining equipment. That's right. The same specialized machinery that underpins much of Bitcoin's hash rate and Ethereum's staking infrastructure now sits inside a potential trade crossfire. If tariffs push the cost of mining rigs and GPUs higher, it hits profitability at the source. Margins shrink. Smaller miners sell more coins to cover costs. Hash rate may flatten. And with that comes a short-term increase in supply pressure, just when demand has started to wobble. Michael Saylor, as usual, wasted no time in defending Bitcoin. Within hours of the tariff news, he reminded his 3 million followers that, quote, "There are no tariffs on Bitcoin." It was classic Saylor. Simple, memorable, and designed to calm the faithful. In a longer interview, he expanded on the thought. Governments can tax gold, they can regulate trade, they can tariff anything that moves across a border. But Bitcoin lives in cyberspace. There are no tariffs in cyberspace. He called Bitcoin the purest, most portable property humanity has ever created. It's the same message he's been repeating since 2020. But in times like this, repetition is reassurance. And to his credit, Saylor's framing matters. When fear spreads, people need narrative anchors. His message is simple. Bitcoin cannot be tariffed, confiscated, or debased. But not everyone shares his optimism. Analysts at LiveMint pointed out that while Bitcoin itself may be immune to tariffs, the ecosystem around it isn't. Mining rigs are built from semiconductors that cross borders. Exchanges rely on payment processors that exist in the real world. Even stablecoins, they noted, have to navigate regulatory rails built by banks that are absolutely exposed to policy swings. In their piece titled "Crypto Market Declines as Traders Seek Safe Havens," They described a migration of capital away from risk into cash and gold, calling it a classic flight to safety reminiscent of 2020. They added, "Until traders are sure the tariff story has a ceiling, they'll trade as if it doesn't." Behind all the panic, there's a mechanical truth to how these cascades unfold. Crypto doesn't have circuit breakers like the S&P 500. It trades 24 hours a day, 7 days a week, and leverage compounds in silence. When a macro shock hits, those positions can unwind faster than any human can react. Funding rates, collateral values, liquidation thresholds, they all move together. If your collateral is volatile, it collapses just when you need it most. That's why professional traders hold cash margin even in bull runs, It gives them oxygen when everyone else is suffocating. Let's pause on that point. Because what's remarkable about this crash isn't just the size, it's the speed. In the space of one evening, over $2 billion in open interest was wiped from derivatives exchanges. Glassnode data shows that long liquidations outpaced shorts by almost 8-1. That's the definition of a cleanse. And yet, in the same breath, spot volumes on major exchanges doubled, suggesting that long-term holders were quietly accumulating into the dip. That's the paradox of Bitcoin. Panic at the top, conviction at the bottom. If you zoom out, every cycle has one of these moments. 2017 had China's exchange bans. 2020 had the COVID crash. 2022 had FTX. Now, 2025 may be remembered for the tariff shock. The triggers change, but the psychology stays the same. Leverage builds, an exogenous event pops the balloon. Fear peaks, then accumulation resumes. It's not a bug. It's the rhythm of an asset class that trades on emotion as much as math. So what are we watching now? The next week is going to be pivotal. Monday's stock market open will set the tone for everything. If equities recover, crypto will likely follow. If they wobble again, expect another round of deleveraging. Traders will also be watching macro data, jobless claims, inflation prints, and Fed commentary. Any sign that the economy can absorb tariffs without derailing growth would be a green light for risk. On the flip side, if the data turns south, the market will double down on caution. ETF flows will be the second key metric. If inflows return mid-week, that's your signal that institutions view this as a buying opportunity, not a breakdown. So far, we've seen mild outflows, but nothing like the panic of earlier cycles. That suggests the smart money isn't capitulating. They're just waiting for a floor. Now, what about the analysts calling for deeper pain? A few macro strategists, particularly those watching the bond market, warn that the tariff story could push yields higher, strengthening the dollar and keeping pressure on all risk assets. Bank of America's digital asset desk said in a client note that Bitcoin could test the 100,000 level if US yields break out. But they also called that scenario transitory, expecting a rebound once rate volatility subsides. Others are taking the opposite stance. Dan Tapiero of 10T Holdings told his followers that he's using this dip to accumulate. His argument is straightforward. Every new geopolitical shock reminds people why borderless assets exist. Bitcoin was built for exactly this environment. Tapiero's been through multiple cycles. His view carries weight because it's not emotional. It's historical. Meanwhile, retail traders are exhausted. Social sentiment trackers show one of the largest single-day drops in crypto optimism this year. Reddit, X, and Discord groups are filled with phrases like, "back to 2022," and "I'm done." And yet, on-chain analytics show something quietly bullish. Wallets holding between 1 and 10 Bitcoin have actually grown in number during the crash. In other words, small holders are still accumulating. They've seen this movie before. If you strip away the noise, what we're witnessing is a clash between short-term panic and long-term conviction. Tariffs might shake markets for a few weeks, but they don't change the mathematics of scarcity or the direction of innovation. As Saylor keeps reminding people, Bitcoin doesn't care about borders, and Ethereum doesn't care about trade routes. The network doesn't read executive orders. It just produces blocks. Still, context matters. Tariffs create ripple effects that extend into supply chains, energy markets, and consumer confidence. If global trade slows, liquidity slows with it. That's why crypto traders care about tariffs that technically have nothing to do with them. It's all about the flow of capital. And when capital tightens, even borderless assets feel the squeeze. Let's talk psychology for a moment because this part matters. People remember how it feels to lose money more than how it feels to gain it. That's why crashes linger longer in the mind than rallies. But what defines a good investor isn't how they act when prices are up. It's how they behave when the screen is red. This is where discipline separates tourists from veterans. The veterans zoom out. They look at 4-year cycles, at halvings, at adoption curves. They know volatility is the toll you pay for outsized returns. And the tourists? They panic sell their future to feel safe for a weekend. The macro setup going into next week will decide whether this becomes a full-blown correction or just a scar on the chart. If the Fed strikes a calming tone, if inflation data is neutral, and if ETF inflows resume, the rebound could be faster than anyone expects. We've seen this before. Markets overreact to headlines and then mean revert once the world keeps turning. But if rhetoric escalates, if tariffs expand, or if China responds aggressively, the risk trade stays under pressure. That's when patience becomes your most valuable asset. Some analysts are even looking beyond the US lens. European regulators are pushing ahead with new MiCA-related frameworks that could ironically benefit crypto in the long run by providing clarity just as the US creates uncertainty. France's recent crackdown on unlicensed exchanges sent shockwaves through the industry, but it also set the stage for a more professionalized ecosystem. Regulation cuts both ways. Pain first, legitimacy later. On the energy side, miners are in adaptation mode. Tariffs on imported chips and hardware may drive a wave of localization. Expect to see US mining firms courting domestic suppliers and energy sector partnerships. Some analysts even think this could accelerate Bitcoin's integration with the broader energy grid, where miners act as flexible power consumers rather than industrial villains. That narrative shift matters for investors who care about sustainability. So where does this leave us? In a word, waiting. Waiting for Monday's open. Waiting for the next inflation print. Waiting for the ETF data. Waiting to see if confidence, once shaken, can be restored. But beneath all that waiting lies something steadier. The network effect. Bitcoin doesn't stop mining because of tariffs. Ethereum doesn't stop validating because of trade wars. Sol doesn't stop producing blocks because of headlines. The rails keep running, and every panic creates new long-term holders who've now learned to stomach the volatility. If you're listening to this and you're feeling burnt out, you're not alone. Everyone who's ever held crypto through a crash knows that sick feeling. But they also know what comes next. It's never obvious in the moment, but time after time, fear peaks right when opportunity is widest. As the old saying goes, markets move from despair to disbelief to acceptance to euphoria. Right now, we're in despair. Disbelief will follow. And somewhere down the line, when nobody expects it, confidence will return, slowly, then all at once. So here's the playbook. Don't trade panic. Don't anchor to arbitrary numbers. Focus on survival, positioning, and preparation. Review your security. Use hardware wallets like Ledger for anything you plan to hold. You'll find the link in the description. Don't take shortcuts on safety, because volatility is temporary, but security is permanent. By next week, we'll have clarity. We'll know how the markets reacted to the tariffs, how the Fed responded, and whether the dip buyers had the courage to step in. Until then, remember, no one ever got rich refreshing the chart. They got rich by understanding the cycles behind the chaos. If you've made it this far, follow the show, leave that 5-star review, and share it with someone who needs perspective after a wild week. This has been the Daily Crypto Roundup Deep Dive. I'm glad you stuck with me through it. We'll be back tomorrow breaking down the next moves, the next data, and the next wave of opportunity. Stay strong, stay smart, and as always, we'll see you at the top.